Good morning, everyone. We'll start with some brief introductions, and then we'll get right into it. We have 6 major topics to get through. So first, I'm Krystyna Blakeslee. I'm the chair of the Real Estate Finance Group at Willkie Farr.
Hi, my name is Anita Laljit. I am a senior originator in the Real Estate Financing Group at Goldman Sachs. I focus on large, complex loan origination and syndications, spending most of my time on underwriting, structuring, negotiations, and the execution side of the business.
Hi, good morning. My name is Laura Rapaport. I'm the founder and CEO of Northbridge. We are a CPACE lender and servicer nationwide, and CPACE is a form of private credit for sustainable improvements in buildings.
Hi, I'm Jillian Mariutti. I'm a senior director in JLL's capital markets team, focused on structuring and arranging debt and equity for owners and developers across the nation.
Hi, I'm Neha Santiago. I'm the head of private credit at Cerberus Capital Management. We focus on originating transitional and bridge loans in the private commercial real estate sector.
All right, so we'll get right into it. Our first major topic is the state of the market. Everyone reads the headlines. Lots of things have been said about commercial real estate, the ups and the downs, and all of that. So the first question, and we'll start with you, Anita, is we all know that transaction volume is down. Some of that is attributable to rising rates. Are there any other reasons that you're seeing for the decline in volume?
Yeah, absolutely. So there's the rising rates and then the cross currents from rising rates. A couple of things that come to mind is the cost of debt. For example, if your existing loan today is at a 4% coupon on a fixed rate basis, you are not going to want to refinance into a 7 or 8% loan. On the floating rate side, you're not going to want to pay the exorbitant cost for a rate cap. And on the acquisition side, you are not going to want to finance your acquisition at a 7 or 8% coupon, depending upon what cap rate your buying assets are. So that's sort of created an environment where our clients are sitting on their hands, right? Unless they have to do something, they're not really going to. The other trend that I see is this notion of your current lender is your best lender. And what I mean by that is if your 4% coupon loan is coming up for maturity, you will most likely go to your existing lender and say, hey, if I put up a little bit of equity, will you give me some more time? Will you give me a year? Will you give me 18 months? And if you're a lender and you don't want to own the asset, you're probably going to say yes. So I think that's one part of it. The other thing that I've seen is what rising rates and the volatility in rates have done to valuations. There's ambiguity in cap rates and discount rates. It's just harder to pinpoint. So what you have is buyers and sellers of real estate are not able to agree on prices. So there's a less sales activity, thus less origination volumes. And the last obstacle that I've seen, not necessarily related to rising rates, is that it feels that there are still less active players in the lending community than there used to be. So you don't have that competition driving loan spreads down that you have had in other environments.
Yeah, I would echo everything that Anita just said. I think on top of that, maybe adding to some of the bid-ask disconnect on valuations is also what we've seen on the operating side with assets over the last 18 months. So obviously inflationary pressure has increased operating expenses pretty heavily. We've started to see a decline in rental growth rates across pretty much every geography as well as asset class. And so both of those combined are putting downward pressure on NOI and resulting valuations. And then there's just been a sharp pullback in liquidity in the market. And that has been a pretty structural change that we've seen in the commercial real estate lending landscape. So banks obviously facing significant amount of regulatory pressure. Everyone in the room, I'm sure, has seen all of the headlines around what's happening in the regional banking sector. The regional banks account for as much as 70% of liquidity in the commercial lending space. So they're a major part of the overall capital markets landscape in our space. And new regulation has just come out. It came out about 2 or 3 weeks ago that requires regional banks to hold significant amount more liquidity against long-term liabilities. So we've seen a big pullback by one of the biggest players in the space as well.
I would also add a lack of consistency from the Fed. If you look at JLL's transaction volume over the year to date, 20% higher transaction volume in the second quarter of this year. And that would be also in line with when we had a 60-day period of the 10-year Treasury settling around 325 to 350. So I think when there's stability in the market tends to adjust accordingly.
Yeah, I think also to echo on back of both of that, an inefficient capital market. So CMBS execution was for so long so much part of the refi process, and that's really not happening. I think volumes are down like 80%. So as a result, there's kind of this, the asset may not be impaired, but the capital markets are, which changes everyone's view of the asset. And then on top of that, there are certain sectors where investors have pulled back completely. I mean, office, for example, has become a 4-letter word. And that's been, even really well-located, well-leased office, people, will say to us, oh, I can't have that in my portfolio. The asset's 100% leased. And I think there's just a lot of confusion and, I don't want to say hysteria, but, certain things people are reading that kind of gets snowballed very quickly, which has very far-reaching long-term implications.
So Laura, to go back to your point you made about the capital markets, CMBS is down. And are you seeing, and Jillian, we'll start with you for this, other lenders or entrants into the market pick up the slack?
Sure. So let's take a look at some numbers here. Year to date, all the debt deals that we've closed, CMBS makes up 4%. Okay, so the banks, believe it or not, take up the lion's share or the majority at 32%. Then you have debt funds at 26%, life companies at 24%, and then agency financing 14%. Now within the banks, the big money center banks are slowly getting more active, but they're really just showing up for their best relationships. They're not really transactionally lending. The local regional banks, which Neha just mentioned, we have seen a pullback, but they are active. They're showing up with more structure. They're requiring recourse and deposits. Some of the deposits are as much as 20% of the loan amount. And the banks are pricing probably in that 225 to 325 range. Debt funds, ample amount of liquidity. That's not the problem. It's just they're expensive. It's the cost of capital that is the bigger issue. And debt fund pricing is across the gamut. Your high 200s to 500, 600 plus over, depending on the leverage and the asset class, if it's construction or bridge, et cetera. So pretty wide. Life companies, you know what they love. They love cash flowing. They love WALT. They are preferring multifamily and industrial. Best insurance company pricing right now is probably around 165 over. They are drying up on their 5-year money for the rest of the year. As you can imagine, a lot of borrowers have been interested in locking in for 5 years because they don't want to lock in this rate environment for too long. So that sector has been, or that 5-year has been very popular. Agency financing volume is down because transaction volume is down. No surprise there. Their best pricing is probably 150 over, and that's for mission business. If you're non-mission, you're probably somewhere around 170 to 190 over. There's a rate buy down concept that's very popular. You are able to pay a point or 2 points up front, and in return, you're getting a better rate by 20 or 40 bips, and therefore you're able to manufacture more proceeds because of that. And then, as we just said, CMBS only making up 4% of the debt deals we've seen this year. But in the last 30 days, we have seen some price compression, and that's off the back of more liquidity we're seeing in the bond buyers across every tranche. And we're also seeing some credit loosening. They're showing up with full-term IO, and they're also sizing the debt service using interest only. So different tools like that we're seeing help bring CMBS, wave in some more borrowers.
Yeah, I would say there's definitely a lot of pent-up demand in the CMBS space right now. Obviously, historically CMBS has been a very cheap source of capital, and today it's much more expensive. So again, you just kind of have that prohibition on whether or not assets can support that higher cost of debt. But for the few issuances that have come out this year, there was ample liquidity for them, albeit at higher at higher spreads, and I think there are a few large transactions slated to come to market before end of year that people feel pretty optimistic about.
What are you seeing, Anita?
Yeah, I would just add to what Jillian, some of her commentary. I do think in favor of CMBS that I think the rest of the year will be strong. I think one of the strongest print that we've seen in SASB since first quarter of 2022 was Goldman's ship deal, which priced last month, where AAA's priced at J145. So we feel really good about the liquidity and the strength of the market. There's a big SASB pipeline going into the fall. And I do think while we've seen a lot of activity from debt funds and insurance companies, the really large deals I still think are going to skew SASB just because it takes, I don't know if you can cobble together 3, 4, 5 life cos to do some of these bigger deals. So I do think look out for CMBS to show up at the end of this year and into next year.
Are you expecting on CMBS that the agented trend will continue? They'll be basically all sponsor risk?
Until there is probably more normalization in rates, or I should say less volatility, and if we could see some depth in the bond buying pool, that probably will be the case. I mean, it's been like that since, COVID, I guess. So we'll see what happens next year.
So what do you guys think, and Neha, we'll start with you for this. What needs to change? Any sort of market fundamentals that you see need to change in order to basically, end the logjam and so that regular transaction volume will begin again?
Yeah, I mean, I think a number of things can sort of help to start to normalize liquidity back into the market. I mean, for one, banks who are sidelined right now aren't sidelined because of sort of lack of conviction around certain deals or wanting to show up for sponsors. It's that they're not getting repayments, right? So it's a kind of one in, one out model. So when you're not seeing the repayments you're expecting, and repayments are obviously down dramatically right now, that's creating a significant logjam on the liquidity side. I think the biggest, frankly, is narrowing the bid ask, and that's going to happen once sellers start to feel a little bit more motivated to move assets off their book. So, it's hard when you've spent a lot of money. Your purchase price is high, your basis is high, you have conviction on business plan, but you're staring at a maturity, and the math just doesn't pencil anymore to make sense to continue to carry the asset. So at some point, the expectation is that we'll see sellers come to the table who are a little bit more motivated. Transactions are happening quietly right now in the marketplace. Banks who need to shore up a little bit of liquidity, some debt funds as well. Sellers, they're quietly going out, maybe not in widely marketed processes because obviously no one wants anyone to smell blood in the water, but there are quiet sales happening between strong relationships right now at slight discounts to par in order to generate liquidity.
I think part of that is also people, to echo that point, people need to have more of a realistic view of where we are. SOFR's north of 5 and the 10-year's north of 4. 10-year hasn't been north of, at this point, since 2007, and no one ever underwrote SOFR north of 5. So when somebody showed me a deal the other day and was like, cap rate of 3%, I'm like, that's not possible. And so I think there just has to be more of a realization of this is the market that we're in as a borrower or a buyer or a lender, and therefore if you want to move forward, this is what it's going to cost. Your profit's going to be down, you're going to have to take different assumptions. You may not go forward with the deal because it just may not pencil, but I think there has to be more of a realization of, okay, here's the environment we're in, and it's not going to change anytime soon. So let's talk with what our options are right now.
So to that point, so to the extent that you're seeing any new deals, are you seeing what big differences, other than obviously the interest rate, are you seeing between deals that are actually getting done now versus say 12, 18 months ago?
I can speak to that. So well, CPACE is a type of private credit, so it's long-term fixed-rate financing that pays for energy efficiency, water efficiency, and resiliency improvements. When I usually talk about that, people are like, oh, doesn't apply to me, I'm not passive house or net zero, but the answer is actually, if you've done a lot of the work to your project already, which if you're an institutional borrower, you have to upgrade your building, then you actually can qualify for this. So we are coming in not only for new construction and renovations, but also very much for refis and rescue capital. And so we're seeing every asset class right now across the country, and the big change has been people using us with a debt fund that might be S plus 700, and suddenly the borrower can get their proceeds, they can get non-recourse financing. It might be a little bit more expensive. It might involve a little bit more structure from the debt fund. They may not have thought about using us, but it's kind of being more creative and thinking out of the box as opposed to the regional bank, who's no longer available to give them the proceeds they want. People aren't getting 80% financing. Or most people are not getting 80% financing. And I feel like 60 is the new 80, and you're happy with 65 non-recourse, and at numbers that we haven't seen ever or in a very long time in the particular, I would say ever in this particular type of asset, whether it's a ground-up construction project or if it's a refi, or if it's a modification to buy yourself more time to hope that you can get more leasing, the market will calm down and later. So I think it's kind of a change of people's perspective and the deals that are getting done. And it's like, okay, here's what I'm going to work with, and I'm going to make, I'm going to use the tools that are available to me now, and it's maybe a different path than they initially underwrote.
Anita, have you seen anything, interesting ways to fill holes in capital stacks, or?
I think probably the most common way is we've seen a lot of pref equity come into deals. I think we've also seen borrowers sell minority stakes, which also helps price discovery of the assets. And I think when all else fails and borrowers are not able to do the deal they want, they're just doing shorter duration bridge or like short-term fixed rate deals to kind of bridge the gap.
Yeah, I mean, I would say certainly there's a need for what we call gap financing, right? Because last dollar proceeds for traditional A-note lenders is definitely pulled in dramatically. Most borrowers cannot fill 40 points of equity in a cap stack. And so there's a real need today for subordinate debt financing, whether it's in the form of mezz capital or pref equity, which has certainly become quite popular in the last 6 months. The one thing that we've seen, particularly with very well capitalized borrowers, is that, and sophisticated borrowers, they're pricing out every incremental cost of debt that they're taking out. And many times the subordinate debt position, so the mezz or the pref equity, is earning higher returns than what the equity might be returning on the deal. And so borrowers, again, well capitalized borrowers who have the liquidity to put the additional equity in are often opting for just taking kind of a lower financing package for the deal and filling that gap themselves if they have strong conviction over their deal, because why pay 18% to your pref lender when you can be earning that 18% yourself as the equity. So it's a little bit of a kind of tale of two cities with different borrower bases.
So do you think, just given the tale of two cities comment, that really is resulted? Do you agree with the sentiment that this market dislocation is really going to end up with the winners and losers, and it's going to be really obvious who's who?
I'll jump in there. I do think there's a bit of the haves and have-nots. Well, let's start with just within asset classes. If you look at all the debt and capital markets transactions we've closed year to date, I would tell you 70% are in the multifamily and industrial sector. So they can be considered the darlings within the asset class. But even within the office sector, you have the haves and have-nots. You have the top 15% within that sector that's getting higher rents than anyone has ever gotten in US history. And then the next 35 to 50%, values are probably down 30 to 50%. And then the back half of the sector, you're in major price discovery mode. And then I could also look at it by the size deals too, from the financing standpoint. If you are larger than 150 million, you're not going to be as easily financed today. The sweet spot is really in that $40 to $100 million range. Bigger is not necessarily better. So you can also view yourself in the haves or have-nots category with just how much financing you're actually in the need for.
I think,
Go ahead.
I was going to say, I think people are using space differently and thinking about space differently, whether it's for your home, for your office, retail, how we go about our lives. There's been a seismic shift in that from COVID. And so office definitely is seeing the have and have-nots, and people are very sophisticated now about, as a consumer, and an office tenant, I spent much of my career building and buying office buildings. The tenants are more sophisticated now than they ever have been, not only at the Fortune 100 companies, but down to the person who's leasing 3,000 square feet, and the demands of what is expected. Everyone needs to have an amenity space. Everyone needs to have, all these other bells and whistles, light and air, because they know that they don't have to settle for what was, normal before, and then the changes have happened. And so that's actually also creating more pressure on the existing stock and then the financing. And there's a lot of buildings that might just become alternative uses. We've seen offices go to vertical farming, office to multifamily conversion. There's a lot of different spaces that are going to be rethought because you can't get the financing or use the space, and the building just might be worth less than land.
So if we're talking about, barriers to financing, like higher interest rates, leasing issues, lower proceeds, the transactions that you're seeing happen now, what's driving that? Is it maturities or?
I have one example. So we like to pay attention and work on must-close transactions. One example would be if you're a multifamily developer and 421A is sunsetting, that means you need to have your property developed and have CFO by June of 26. That means you need to be starting construction this year. You don't have the luxury of waiting for rates to improve. You need to close that construction loan right now. So that is an example of where you're creating this must close, must transact type of feeling.
Maturities are driving a lot of the deals, and I think people whose maturity extensions, they thought, okay, well maybe SOFR will come down and the market will be better, and now we're post Labor Day and it's not. There's a new realization of, okay, now what, and how do I work with my my lender or not?
So we've been talking a lot about direct lending to property owners, but there's a lot of lenders out there like debt funds who have back leverage, warehouse financing. Anita, are you seeing any changes in that kind of product? Other than volume is probably also down, just given.
Yeah, so loan on loan, warehouse financing, it's been pretty popular. I think now the trend continues. Warehouse financing, the activity follows the broader origination market, so obviously activity is down, but I think they're seeing other opportunities. Like we have over 60 lines at GS, and we're seeing opportunities come in from our clients that want to do more distressed lending. So there are areas where we're seeing opportunities. Another part of the business that I think is interesting, kind of related to the warehouse lending in general, is single asset loan on loan type financing, right? So we do see a lot of construction requests right now. And when you look at like risk adjusted returns versus what you can get for cash flowing assets, it doesn't quite make sense for us, but where it does make sense is doing like an A-note financing for someone that is doing construction lending for an asset class we like. So that's sort of where I see the opportunities in that space.
So I actually personally worked on 2 warehouse lines this year, and the need for that was, so when you have volatility, there are some groups out there that benefit during these times, right? Like when we were all in quarantine, who benefited during that was Netflix. So who's the Netflix in this current environment? Who was getting more business because of this volatility and maybe banks pulling back? And it could be some of these higher octane debt funds that are seeing more deals than they ever would have. So they may need more liquidity. And that resulted in 2 debt funds reaching out to us to help them find that warehouse line and that extra leverage and liquidity. And we were able to successfully close 2 just in the last 2 months.
Yeah, I would say, most of our warehouse lines are with strong existing relationships. And I think one trend we're certainly seeing right now is that relationships are key, right? So where is their liquidity? It's for existing borrowers. And with our existing warehouse lines, we've continued to see our lenders show up for us. There's certainly been a little bit more restriction around what their appetite is. Again, they're kind of leaning towards favored asset classes. They maybe want a little bit less construction exposure than what they would have had appetite for in a more normalized environment. And they're pulling back a little bit on advance rate. We've seen rates, actual cost of capital stay relatively stable, but 2 years ago we could have kind of easily gotten 70, 75, maybe 80% advance on our non-recourse warehouse lines, and today a more normalized advance rate is sort of 65 to 70%. What I wouldn't want to be doing is taking out a new warehouse line today, because I think that given lack of liquidity, the lenders have all the negotiating power on structure, and structure sort of the magic word right now. Everyone wants a lot of structure. We also do, obviously, as lender, but existing warehouse liquidity, we have found continues to be there. And there's certainly a lot more demand in today's market for the note-on-note, A-note financing.
So sticking with you, Neha, have you been seeing more distress in the market? I mean, we all see the news, right? It seems like every so often you hear about, XYZ loan has been in default, and it's usually tied to an office property. But those also feel, at the same time, they feel very ad hoc, right? It doesn't feel like we've gotten this onslaught of distress, but interested to see what you're seeing and what your crystal ball says.
Yeah, I think right now, most of the quote-unquote distress that we have seen has been pretty concentrated in the office sector. I don't think there's any other asset class that's feeling quite the pain that office is feeling. I think we certainly expect to see it. We're a little bit cautious on many of the multifamily trades that happened over the last 2-3 years at sub 4% cap rates that just can't really carry the burden of the high cost of capital, and where sponsors probably bought at those very low cap rates expecting to be able to exit at 4.5% cap rates, which at some point I'm sure we'll talk about our view of interest rates, but I'm not sure that in the next 24 to 36 months we're going to be back in a 4 cap environment. So I would say distress today pretty isolated to office, but again, what we are seeing is very quiet transactions happening off market where lenders need to move positions. It may not even be a troubled position. It may be a very well-performing, great credit position. There's something we're looking at in New York City right now, really well leased, 97% leased, brand new multifamily asset in a well-located submarket, highly amenitized area, but the lender just needs to shore up a little bit of liquidity for their balance sheet, and so they're willing to move it at 92 to 95 cents on the dollar, and that's a pretty attractive buying opportunity for us for a stabilized asset.
Right. How about you, Laura? Have you been seeing anything?
Yeah, I mean, I think that the market right now, again, based on all the changes that we're seeing, people's expectations have been reset, and so as a result, people didn't know that they could access our capital, and they're using it for different use cases. Pay down your lender, blend and extend, and maybe pairing that with some pref. Maturity coming up, going in as a synthetic A-note, because the A-note market is so tight right now, or non-existent, and the existing lenders on a deal, and I think to Neha's point of pricing it out, people will price out the A and the B, and what does that look like in the mezz, and the incremental cost is astounding, but the goalposts keep moving because a lot of these lenders' liquidity is tied up, and people are doing deals not because of the asset, but because of their own capital markets requirements or needs. And so as a result, coming in as the A-note, coming in as just a formal refi to help unlock the deals. We're seeing every asset class now, but the expectations are very different.
Yeah, I think one thing to keep in mind is, real estate fundamentals, save for office and maybe retail, traditional retail, are still pretty strong, right? So we have to be careful not to sort of paint the entire real estate sector with a broad brush. Most sectors are still continuing to perform. Fundamentals are still very strong, even though rental rates growth rates are starting to decline. We still have positive year-over-year rental growth rate. And then, one thing that's different in this cycle versus the GFC is that there's really good dispersion of where all of these loans sit. So, Jillian did a great job in the beginning of really, laying out the landscape of who all of the active lenders are in the space, it's pretty well diversified, right? It's not all sitting concentrated with just the banks, sort of like it was, back in the GFC. And liquidity pressures aside, banks are really healthy, right? They have very, very strong balance sheets. And so, the expectation is, my expectation, when you asked about my crystal ball, is that most lenders are probably well suited to work with borrowers and do some blend and extends, do some restructurings, require some fresh equity to pay down their basis, but to kind of weather through and work through, because the fundamentals are still strong. It's just really more of a high cost of capital markets driven, pain point that we're feeling right now.
I would just add, yes, we've seen a lot of pressure in office, but there are other asset classes that I do think are being affected by not so much a rate, but what's going on in different areas. So for example, studio, we're seeing a lot of stress in studio assets. We're seeing a lot of stress in life sciences. Anything, to Neha's point, anything that was underwritten to really tight debt yields. For example, we just foreclosed and sold on the Veritas multifamily portfolio. There's distress in practically every asset class in San Francisco. So I think, it's very specific to every lender's book, but there are different, and it very much depends on specific deals, but there definitely is, I would say, distress or more just high touch asset management in general, because right now, even if you have a performing loan, every rate cap that comes up for renewal, that's a conversation. Every LTV test for extension, that's a conversation. So I just think overall, if it's not distress, things are just way more high touch and people are spending much more of their time on asset management.
Going back to the rate cap and the cost of it, have you seen any sort of creative ideas in terms of reducing the monthly cash burn to help borrowers get through whatever it's 18, 24 months, whatever you think?
Look, I could expand on that a bit. The interest rate risk management and hedging strategies are being talked about now more than in the last 15 years. And there is some ways you can creatively hedge this interest rate risk that's going to end up making the deal pencil better. For example, because I like to use examples, I have a client who's working on a multifamily construction loan, and the lender, we've been in closing for months, and rates really moved. And the lender came back to us recently and said, unfortunately, we're not hitting that 1.0 debt service coverage ratio anymore. The borrower's going to have to put up another $5-10 million in equity. We're like, what? That kills the deal. So they were like, all right, so now let's figure out the math. What can we do? When rates were lower, it worked. So SOFR needed to be at 2% for us to hit that. So now we can talk about buying an interest rate cap at 2%. And let me tell you, it's a lot cheaper than the $5-10 million they were saying the equity they needed to put up. It's probably less than 10% of that. So these are the strategies that we need to think about creatively to manage the interest rate risk so that we get some of these formulas and hurdles and metrics met.
To your question specifically on rate cap costs, what we have done for strong borrowers, not that I advertise that we do this, but we will give them some relief on the strike rate of the cap and allow them to guarantee portions of the cap or exposure from the cap. But just generally, if it's like a construction loan, for example, there's rebalancing, or even if it's just a loan where you had a carry guarantee and there would be carry rebalancing, we're allowing them to put up guarantees, and I think that's probably the primary way. They're still obligated for things, but to relieve like the actual cash that they have to put out.
Yeah, and 2 years ago when rates started to increase, the biggest shift was originally you had to buy a cap through initial maturity, right? And it was a de minimis cost, and so no one really fought back. Today, max 12 months, and some borrowers are asking for 6 months.
Like a rolling cap. So once that cap comes to maturity, then you could buy another 1 year and so on. It makes it more.
Well, our time is flying by, so I think we're going to do some Q&A from the audience, and then we have a quick lightning round before we end. So I'm not sure if there are folks with microphones stationed throughout, so if you have a question for the panel, you could just raise your hand and someone will find you.
What about the requirement for equity first and what it's doing to your borrowers and potential new deals?
So I'll just repeat that in case anyone didn't hear. So the question was, what are you doing about the requirement for equity first? Is that an actual requirement? And if so, what's the impact on potential new deals?
We haven't really changed our stance on kind of sequential versus peri funding, as long as we feel like we have a deep-pocketed borrower and we're getting an equity guarantee. So even before today's environment, we required an equity funding guarantee if not all the equity was going in ahead of the debt, and I would say that that's still a requirement that we would have today. But we still have appetite for peri funding.
Thank you. Anyone else? Hard to see everybody.
I think there's a.
Given the current climate and all the uncertainty, what advice would you give to young men and women at Shack who are wondering what courses should they take, what internships should they be going for, what career path, what kind of opportunities will be available?
I'll take that. So I think now is an incredible time to start and to learn. And we're in a market we've never seen before. And there's going to be some people who are really going to succeed and some people who unfortunately will not. But it's an opportunity to kind of see everything and just learn from as many people as possible.
Yes.
Take a risk.
Talk to everyone and anyone that's willing to give you time.
Yeah, and dig in and learn. I mean, I started in the early 2000s. It was not exactly the best market, but it was an incredible learning opportunity. And so you learn more in a time of trouble than a time that everything is great and you can buy something for a 3 cap because suddenly now you have to deal with that. And now what do you do? How do you actually make these numbers work, and how do you get to a resolution?
Exactly.
Anyone else?
I have a question. We've been talking about the lending climate that we're in. I was hoping to talk about the literal climate that we're in. Are you shying away? Oh, great, thank you. From certain geographies based on the lack of insurance that is available in certain markets as certain insurers back off?
Look, insurance has definitely impacted underwriting significantly, and it's making some deals not pencil. So, we're looking at it with a fine-tooth comb and making sure we're underwriting things correctly. But I'd be remiss to tell you that some deals have been put on pause for exactly that reason.
I recently, for the first time ever, saw an insurance shortfall guarantee with a deal in Florida. So that was, I think we're going to see a lot
We'll
more
probably see more of that.
of that. Yeah.
And we're very upfront with people in Florida about our requirements for insurance. And it was actually a sticking point in a deal. We wound up getting there, but it was hard, and we wound up getting very well versed in all the different aspects and trying to be creative about the structure for something that would give us the coverage we needed, but also to be realistic about the environment we're in.
All right, we have 25 seconds, so we're going to go through the lightning round. All right, we'll start with Anita, and we'll go down for each one. So office or retail?
Retail.
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 Grocery anchored retail.
All right, interest rates, your choices are continuing to go up, remaining flat, near-term decline.
Flat to near-term decline.
Flat.
That's option 4.
I mean, like,
Flat.
Flat.
Up.
Oh, okay. Talk or text?
text.
Talk.
Talk.
Text.
Ask permission or forgiveness?
Permission.
Depends on the situation, both.
Forgiveness.
Forgiveness.
Best thing you did this summer?
My parents took my kid, and me and my husband went on vacation by ourselves.
Oh, nice. So jealous.
My brother got married, so that was very exciting.
Beach with the family.
I signed off of social media.
All right.
The audience.
The next one is fill in the blank. Taylor Swift is?
An economic phenomena as well as a musical one.
Yeah, even as the Laurie's comments, even better than Beyonce in terms of revenue growth. Girl boss.
Helping our economy.
Fierce.
All right, last one. In 3 words or less, what keeps you up at night?
First birthday party planning. Sorry, that was more than three words.
My children and navigating traffic and logistics with the UN in town.
A teething baby.
My short-term floating rate mortgage.
Thank you all so much. Thank you.